Hi, thanks for tuning into our final video for the quarter. I'm Tim Chubb, Chief Investment Officer here at Girard. Today we'll take a bit of a longer view and see what history can tell us about how stocks perform post-inflation, economic downturns, and geopolitical shocks. We've been here before and we'll certainly be here again, so it's valuable to look back and assess whether this time is actually different. We don't think so, and today is not the right time to bet against history. This year has certainly been a challenging one for investors, and at times it may feel that risks facing the financial markets are insurmountable. Inflation, geopolitical risks, and central bank policy have all lent to market volatility and have resulted in the stock market reaching a bear market or a decline of 20% from its prior high. But like it is important to stay disciplined during a bull market run-up by taking profits and staying diversified, investors find it more challenging to stay the course during short-term market volatility and introduce different risk by ceding to the temptation to time the market and disrupting the best laid long-term plans. Market volatility is unavoidable, and there'll always be uncertainty. However, it's important to stay focused on long-term fundamentals while still being aware of the present. Understanding the financial market tendencies is essential, and history often provides us helpful lessons. Bull markets have historically been longer and more sustained than bear markets, and consequently, those who have stayed invested have benefited from subsequent rebounds. This chart reminds us that the path of wealth is not always a straight line. It shows various allocations from all bonds all the way on the left to all stocks on the right over the last 95 years. A balanced allocation of 50% in stocks and 50% in bonds, or even 70-30, can be found in between. You'll see that the average returns rise as the mix of stocks moves higher, but the orange space shows the range of volatility in annual returns for those allocations. Clearly, the more stocks, the more volatility, so the more you take on risk, you want to have a longer time horizon. The stock market can be volatile in the short term. It can decline substantially in a short period, creating fear amongst investors. But by staying calm, investors will find the likelihood of a positive return grows higher the longer the one stays invested. Unfortunately, those tempted by buying high and selling low, missing the rallies after the challenging periods, drops of more than 20% have been historically rare, but are expected to be the price of building long-term wealth. In fact, when markets fell between 20 and 30%, 90% of the time they fully rebounded in under a year. This chart illustrates how the S&P 500 index has performed after some of the worst bear markets investors have experienced in the United States. Each bar represents a period of returns following the bottom of the bear market and underscores the importance of sticking to that long-term plan. Now take 1987, Black Monday, which was 35 years ago this October. For those who lived through that volatility, one would have thought the world was coming to an end. The peak to trough decline that year, 34%, but the year ended up 2%. The R word, recessions. We've been there before and we'll certainly be there again. But an important point to keep in mind is that the stock and bond market are forecasting machines. They try to predict what will happen in the economy and price assets accordingly. In reality, most of the price declines are leading up to the actual recession as investors price in how the economy will impact corporate earnings. During economic decline, stocks on average actually have positive returns. They eventually recovered their ground and rose just as they have past market declines. This is nearly an identical story following periods of peak inflation. The recent rise in prices has certainly led to even the most patient investors wondering if this time is different. It turns out that every single bear market resulting from inflation has also ended. Benjamin Graham, the father of value investing and mentor to Warren Buffett, said, "Individuals who cannot master their emotions are ill-suited to profit from the investment process." We often repeat during bear markets that a successful strategy focuses on the time in the market, not timing the market. Acting impulsively in the short term could have significant negative consequences when trying to achieve one's long-term financial goals. And finally, as we head through the fall and into winter time, we wish the best for you and your family. Thanks for joining us, and please reach out to us at meetgirard.com or your advisor to learn more.